What's going on, everybody, and welcome back to another episode of the Trade for Yourself podcast, where my mission here is still very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So make sure you please subscribe. Make sure you hit that notification bell so you can be in the know every single time I drop an episode. As always, please understand that this is not financial advice, so please do your own research before investing into any stock. In this episode, we're going to be rehashing Tesla's earnings report. Now, Tesla had a not so good earnings report in terms of revenue and in terms of profitability, but the stock increased a lot in spite of that because of a few key things. We're going to break down that, look over some things around the company, and we're still going to talk about why I believe in it long term. Let's get into it. Okay, y'all. So normally I don't start with the charts, but I want to go to the charts just to provide a little context around what this stock has been doing. Now, if we've been following this stock for the last year or so, we understand that this stock has been down massively. The stock is down more than 52% from the 52-week high, and I believe it's down around 40% year to date. So the stock has been getting beaten down pretty significantly, but I believe that it has been undervalued. The stock was as low as $138.80. I've been recommending this stock. I think I was recommending it around 170, something like that. The reason being is because I thought that we needed to establish a position, build that position, and as the stock goes lower, just average down, because I understand and I believe in the long-term thesis for this company. Now, this is just a daily chart looking at what the stock has been doing over the last year. Let's dig a little deeper and let's see what happened after earnings. So this is an hourly chart, and this is a very short time frame, right? But as we can see this $138.80. We can see that level that it came down to, but the stock went up massively after hours, after it reported its earnings. Now, this is something that we need to understand about stocks and how they move. Earnings is a very, very, very volatile time for stocks. Stocks can go up massively, they can go down massively, or they could just lay right in the middle and they could trade sideways after earnings. Now, the one thing that you have to pay attention to is you have to pay attention to what does the stock do after the company releases earnings, and then also what does the stock do after the earnings call, because the earnings call is very, very important, because we get to learn from management. We get to see how certain investors ask questions and things of that nature. So the stock could move differently even after it releases that first initial report. Secondly, we also have to react and see, okay, how does the stock react tomorrow? How's it going to react tomorrow, during our next trading day? Because the stock could continue to rise higher, or it could reverse trend, and it could, close, significantly lower from where it is. So we have to take into account, what does the stock do on the initial reaction, what does it do after the earnings call, and what does it do in the next trading day and subsequent trading days. So I had to come on here, show you all what was going on, and put this into context. Now, I still believe in this stock over the long term. I wouldn't recommend that you go buy the stock tomorrow necessarily, because I would like to see how things shake out. But you still need to be adding to this stock. You still need to be understanding the long-term thesis. And we're going to look into this earnings report and see why the stock has rose as much as it did. All right, everybody. So we're going to go through this Tesla article related to its earnings. And Tesla stock is currently up 13.33% after hours, which is very, very significant. Again, we are going to have to pay attention to see if that holds on the next trading day. Now, what did Tesla report today? Okay, Tesla reported a 9% drop in first quarter revenue on Tuesday, the biggest decline since 2012. and missed analyst estimates as the electric vehicle company weathers the effect of ongoing price cuts. The stock jumped and extended trading after CEO Elon Musk told investors that production of new affordable EV models could begin sooner than expected. Now let's see what the company did with Wall Street. Now, the earnings, we had 45 cents per share on the EPS side versus 51 cents, and we had 21.3 billion in revenue versus 22.15 billion. Now, revenue declined from 23.33 billion from a year earlier and from 25.17 billion in the fourth quarter. Net income dropped to 1.13 billion or 34 cents per share from 2.51 billion or 73 cents per share a year ago. And the drop in sales was even steeper than the company's last decline in 2020, which was due to disrupted production during the COVID-19 pandemic. Tesla's automotive revenue declined 13% year over year to 17.38 billion in the first 3 months of 2024. Now, I just showed you the chart and I just showed you how negative the stock has been. And these are negative results. Like normally when you get these types of results, normally you don't see stocks increase. The big difference between this situation is that a lot of this negativity has already been priced in, right? Wall Street is a forward looking mechanism. They're always pricing things in, right? So it's all about the story. It's the story around the particular situation, right? And so Wall Street looks at the situation, they say, yes, you all had a bad quarter, but at the end of the day, what is the story moving forward? Right? What are we looking for moving forward? So let's talk a little bit about what is Wall Street expecting moving forward. Now, Musk said on the call that the company plans to start production of new models in early 2025, if not late this year, 2024, after previously expecting to begin in the second half of 2025. Musk also touted Tesla's investments in artificial intelligence infrastructure and said the company is in talks with one major automaker to license its driver assistance system, which is marketed in the US as the full self-driving or FSD option. Now, when we really take this into consideration, this is something I've been talking about in relation to this stock. We understand that Tesla is going to roll out the Optimus robot, the humanoid robot that's going to be able to do certain tasks. They believe that the robot can start actually doing tasks by the end of this year, and they believe they can begin selling these robots by the end of next year. That's a big deal because Elon Musk, he said that the robots by themselves could be worth more than any other aspect of the company. Another thing we have to understand is that autonomous driving is happening, everybody. It is happening, and they are going to make this work, and it's going to be successful. Please understand what they have rolled out with full self-driving version 12. Please understand what they have done. Understand the data that they have been continuing to get, and that's very, very important. The third thing is that Wall Street is trying to understand Tesla and understand the story, right? And so in order for Tesla to start back going higher, we also have to have a change of the story. And so Wall Street wants Tesla to have cheaper vehicles because they view the EV market as declining very significantly, and they believe that their vehicles are too expensive. Whereas I believe, and most other investors that understand the stock believe, they say, hey, this is only a period of time because we see many other automakers shelving their EV plans, not producing as many EVs and shifting to hybrids, which that could be a very, very grave mistake when we get out of EV winter. Because trust me, we're gonna get out of EV winter, y'all. Do not think that EV adoption is not happening. It is happening, and Tesla has not stopped producing vehicles either, and they're going to be in prime position to take advantage of what is going on. So let's continue to move forward. Now, In its shareholder deck, Tesla reiterated a pessimistic outlook for 2024, telling investors that volume growth rate may be notably lower than the growth rate achieved in 2023. Now, again, like I said before, this is something that's already been priced in, and the market already knew that. Now, prior to the 11% jump after hours, Tesla shares were down more than 40% this year, reaching their lowest since January 2023 on concerns about weak deliveries, competition in China, and the company's ongoing price cuts. Earlier this month, Tesla reported an 8.5% year-over-year decline in vehicle deliveries for the first quarter. Now, the company said in the deck that it's accelerating the launch of new vehicles, including more affordable models that will be able to be produced on the same manufacturing lines as Tesla's current lineup. Tesla is aiming to fully utilize its current production capacity and to achieve more than 50% growth over 2023 production before investing in new manufacturing lines. Also in the deck, Tesla showed off screens of a robotaxi based ride hailing service. The company has been promising a self-driving vehicle for years without delivering on Musk's promise. So this is a major thing because, like I said, Wall Street wants to see a more affordable EV model. And here's the thing, Tesla's going to be able to deliver on whatever they want to deliver on. Just pay attention to what they have going on. Pay attention to the ramp that they've been doing in manufacturing and just see everything that they have been doing, because everything that they have going on is very important. Let's go a little further because I believe that there's some more intriguing stuff in this particular article. Now, sales growth across EVs is slowing, and Tesla and key rivals have been slashing EV prices to try to spur demand. Tesla's gross profits plummeted 18% in the first quarter, partly due to price cuts this year. After discussing operational challenges in the first quarter, including Red Sea supply chain disruptions, Musk said on the call that we think Q2 will be a lot better, right? A lot better than what they had been saying before. And Tesla said that total sales included revenue from earlier sales of its FSD option. The release of a feature called Auto Park in North America allowed the company to recognize the deferred revenue. Chris Reddle, autos analyst at Siena Capital, estimates that Tesla recognized as much as $700 million in deferred revenue in the quarter from FSD. That's roughly 4.3% of Tesla's automotive revenue after stripping out regulatory credits. Now, that is a very big deal. We're talking about FSD generated about 4.3% of Tesla's automotive revenue in the quarter after taking out those regulatory credits, and we're not even using autonomous driving at full scale yet. We're not even at full scale yet. So what could happen whenever we get to autonomous driving at full scale? Because we understand that Tesla is the only company that has figured it out in the way that they have figured it out. In addition to that, they're saying that they are in talks with one major automaker about licensing FSD, right? Other vehicle companies, they've already said, hey, Tesla, we're going to use your infrastructure. So now they're going to use Tesla's infrastructure. Now they're talking about, hey, we're going to use your FSD. The data, I'm telling you, everything is lining up for this company to do everything that we believe that it can do. And you need to do the research and you need to understand why this is a solid company. Now, Tesla embarked on a massive restructuring this month, with two executives, Drew Baglino and Rohan Patel, resigning. Musk said last week in a company-wide memo that the automaker was cutting more than 10% of its global workforce. Now, that was something that actually caused some negativity into the stock when this news had came out previously. Now, capital expenditures rose to $2.77 billion, up 34% from a year earlier. Free cash flow turned negative in the quarter, with the company reporting a deficit of $2.53 billion. I will acknowledge that this is the first time the company has produced this in a while, And a year ago, Tesla reported free cash flow of 441 million, a number that reached 2.06 billion in the fourth quarter. Now, Tesla attributed the negative figure to a 2.7 billion buildup in inventory and a 1 billion in capital expenditures on AI infrastructure. Revenue in Tesla's energy division increased 7% to 1.64 billion, while services and other revenue rose 25% to 2.29 billion compared to the same period last year. Now, what was interesting was that Elon Musk was asked on the earnings call if he has any intention to leave Tesla, given his many jobs, including leading SpaceX, controlling X, formerly known as Twitter, and running other businesses. Musk did not provide an answer, but said he spends the majority of his time at work, rarely even takes off a Sunday afternoon, and will work to make sure Tesla is very prosperous. Okay. And at the conclusion of this call, Tesla's Martin Viecha, vice president of investor relations, said that he's leaving the company in a couple of months after 7 years, and Musk thanked him. Now, we just went through a lot of information. We went through a lot of information and we understand what is going on with Tesla. We understand that right now Tesla is trying to change the story. They're trying to change the story around the company, and they're trying to let everybody know about what they are doing with AI, what they are doing with AI, what they are doing with robotics, because that's going to be very, very important in terms of understanding what this company can do and what I believe this company will do in the future. And so before we get out of here, I want to look at Tesla's balance sheet. And this is what makes me very, very confident as an investor. And this is something that many people in the media do not talk about in terms of how good Tesla's balance sheet is. The first thing I want to look at, and really the most important thing that we want to look at first when looking at a company, is the current assets versus the current liabilities. The current assets is the money, the revenue, whatever it is that we're expecting to receive this over the next 12 months. And the total current liabilities is the money that we are expected to pay out over the next 12 months. And that's very, very important, because that tells us, okay, what are we expecting to do as a company over the next year? If we don't have the ability to pay our bills over the next year, then we may not be in position to be able to accomplish any level of sustained growth or any strategic initiatives that we may be trying to do as a company. So total current assets, total current liabilities, we've got 50.5 billion in total current assets. We got 29.4 billion in total current liabilities. So when you take that, so when you do that current ratio, you take your current assets divided by your current liabilities. You want that number to at minimum be greater than 1. At minimum be greater than 1. But when you get to that 2, when you get closer to 2 and above 2, we're really looking good, because now we're pretty much saying that, hey, we can be good for 2 years in relation to what our current liabilities are. And so when you do that calculation for this company, they're about 1.75 billion, which is still good, which is still very, very good, exactly where I like to see them. You know, their cash and their cash equivalents, 26.8 billion. It was down from 29 billion from last quarter, but their debt is still around 2.8 to 3 billion dollars, which is great. A company with a low amount of debt is very, very hard to go out of business. And so what I would encourage you all to do with Tesla, with any other company that you want to invest in, check out the balance sheet. Check out the balance sheet, because the balance sheet has to be intact if we're going to put our money behind it, because we have to make sure that this company has the ability to add value to shareholders, and we have to make sure that management, at the end of the day, what I've said and what I'm about to say is literally just my opinion. Everything that Tesla has been through reminds me of what Meta went through just 2 years ago. Meta was downtrodden. That stock was below $90 a share, and now we're talking about a stock above $500 a share. There were questions around Mark Zuckerberg. There were questions around the shareholders and the board of directors and his management and the people right underneath him. Could he control the company? Could he actually lead the company to where they needed to be? There were questions around how they were spending money and how much money was being spent and all of these things. But eventually the company turned it around, and we're talking about a 5x, greater than 5x, almost 6x return from that bottom. What I'm telling you right now is that Tesla has the ability for this to be the greatest buying opportunity this company has ever had, being down 50% from its 52-week high, being down 40% year to date. This stock still has everything that it needs to recover and be a great long-term investment. But you have to do the research and you have to believe in the thesis around everything that this company has built and is currently building and what they will build in the future. As always, I appreciate you all for tapping into another episode of the Trade for Yourself podcast. Please like this. Please subscribe. Let me know if you have bought any Tesla stock yet. Let me know if you are a Tesla shareholder or if you've been a Tesla shareholder. And let me know what you believe about this company. As always, remember, don't pay for it. Trade for it. I'm going to tap in with y'all in the next episode.